book more fleshes out the argument of why. What is the reasoning behind that fact? And the basic argument of the book is that debt, at the end of the day, is a contract that has to do with the distribution of wealth in an economy. And that is, who are debtors, especially on the household side? Debtors tend to be households who are in the middle to lower part of the income distribution. And they tend to be the households that have the highest, what we call, marginal propensity to spend out of wealth shocks. So that, the analogy we give is, if Bill Gates loses $30,000, Bill Gates doesn't even know he lost $30,000. Right? If a household who only has $50,000 of net worth loses $30,000, then they're going to cut back spending in a very dramatic way. So then think about what debt does. Okay? So I am a University of Chicago professor, so I have to do some lecturing. So the way debt works, as you all know, is the junior claimant or the equity holder or the homeowner is going to experience the first loss associated with the decline in asset prices. So what debt is essentially doing is it's imposing the losses on exactly the people that have the highest marginal propensity to spend out of these wealth losses. So you're essentially having the worst kind of risk-sharing arrangement you could possibly have. And that is, you're focusing the losses right on the individual who you know is going to cut back spending the most. And so that just, to us, doesn't make sense. A successful financial sector, we think, should have more risk sharing, and investors should have more of the upside as well. So there I am, a University of Chicago economist too. If investors bear downside risk, they should also get some upside potential. And so that's why we think equity arrangements would be a better solution and help us get out of this kind of vicious cycle.
And specifically on the debt, why is a sharp rise in household debt associated with that economic contraction?
Yeah, so what you tend to see is exactly that during these periods. So one of the arguments of the book is essentially split into three parts. One is why debt leads to bad downturns. The second part is why debt leads to bubbles. Why does it fuel these unsustainable house price bubbles? So we go through, and I won't bore you with the details, but we go through some very careful econometric analysis in order to try to prove that debt tends to fuel bubbles, not the other way around. Right? You could argue that a housing bubble starts and then debt just comes in. We make the argument that actually there's something about debt in particular that fuels asset price bubbles. So if you'll bear with me, let me give you like a 3-minute example. So this hopefully will illustrate why it is that debt fuels bubbles. So suppose this side of the room is very optimistic about what's going to happen to house prices in Dubai. Okay? So you all think house prices in Dubai are going to go up by, let's say, 30%. Okay, over the next 3 years. People on this side of the room, you're not so optimistic. You think maybe they'll go up by 5%, 10%. They're never going to go up by 30%. Okay, so this is a model in which we have difference of beliefs. You all are more optimistic than you all. Okay? Now let's suppose, for the sake of argument, sorry to do this to you all, but let's suppose that most of the money is actually over here. Okay? So over here, you all have very optimistic house price expectations, but you don't have that much money, so you can't buy homes. Right? And you over here are going to be the price setters because you're the ones with money, so you're going to be setting the price of homes. In this situation, what's going to happen to house prices? Well, they won't go up by much because you all aren't that optimistic, so you're not going to bid a high price for a house. Now let's suppose we introduce debt into this economy. Okay? What's going to happen? Well, all of you all are quickly going to go ask these people for their money. Right? You're going to say, I want to borrow. I want to borrow money to buy a house because I think house prices are going to go way up. So I want to buy a house in order to get this investment opportunity. Okay? So they lend to you, you buy the house, which obviously you buy at a much higher price because you have higher house price growth expectations. So you might be willing to say, right, well, why would they ever lend to me? If they have pessimistic expectations, why would they be willing to lend to me, who's the optimist? That is essentially what a debt contract allows to happen. Because the individuals on this side of the room understand that you all have these crazy expectations. They think that you guys are, have these expectations that are unrealistic, but they have the senior claim on the home. So as long as house prices don't crash too much, they kind of feel safe. They say, look, I'm willing to lend to you because maybe house prices aren't going to go up 30%. As long as they go up 5%, I'm willing to do it. And so what debt does is it transfers the buying power from more pessimistic people to more optimistic people, therefore pushing up house prices. Okay? And this is something that would not happen if we did equity financing. If we did equity financing, the people on this side of the room would say, look, I'm going to experience the loss if house prices don't go up. right? If they don't go up by 30%, I'm going to have some loss because I'm sharing equally with the people who are buying the homes. And that's our argument for why debt is almost always associated with bubbles. And it's usually a type of debt where everyone believes it's safe, right? That's always the AAA mortgage-backed security. Everyone believes it's super safe. You understand why it has to be that way. The only way they're going to be willing to finance the purchase of homes in, the Central Valley in California to subprime borrowers who don't have any money, to do that is if they feel really super safe with the securities they're given. Okay? And it's that illusion of safety that debt offers that is usually associated with these big bubbles. And I think it's really a message that you see over and over in different countries.
Maybe we can take questions from the audience. Mike?
Professor, I'm curious if you've done any work on student loans, because that's the other big bubble that's waiting to sort of sort itself out.
Chapter 11 in the book. So yeah, we do a lot of talking. We talk a lot about student loans in the U.S. That's where my specialty is. So I'd be happy to hear from people who know more about student debt in other countries. But I know mostly about it in the U.S. And it's truly an alarming situation. So student debt in the U.S. is now over $1 trillion. For an economy with GDP around 15 trillion, I mean, it's a large amount of student debt. And in particular, what we're seeing is it is actually holding back consumer spending of younger individuals, people between the ages of 25 to 34. You're seeing people with a lot of student debt less likely to buy a car, less likely to buy a home. This is a situation in which the dangers of debt are really obvious. Student debt is done in a way that's incredibly inefficient, right? Who bears the risk of student debt? If I start college in 2005 in the United States, and I take on a lot of debt, I graduate 4 years later in 2009 into the worst recession in the last 100 years, right? That's through no fault of my own. There's no moral hazard reason for making me bear that risk. We're making people with no assets who are young, who have their whole lives in front of them, bear all of this economic risk, which makes no sense. And in fact, there's a few companies, one out of Latin America, one in the US, that's trying to innovate and do more equity-based student lending, which I think is a very good idea. So it's basically saying, look, we'll finance your education, and then we take some fraction of your earnings going forward. So if you end up being a very rich banker, then I get a higher payment from you. If you end up being, a teacher who makes less money, I get a lower payment from you. That's, to me, a much more efficient way of bearing risk rather than forcing all the risk on the student.
On China, I wanted to ask you a question on China.
Yeah.
We saw in November, December, 2 months when the market was very volatile, and the impact China, crisis in China had.
Yeah.
It turned out to be that it's covered up nicely right now, and it's not. But in your last slide, you spoke about China being pretty explosive on that chart, on the debt, household debt chart.
Yeah.
Do you think, when the real facts come out, you talked about the suspicion around the GDP numbers, that will trigger another world crisis?
Funny enough, I had a slide that I didn't show, which was all about how China's affecting global markets. But I think that the evidence that is credible is telling you that China's in real trouble. Okay? I don't think you could see the kind of decline you've seen in commodity prices unless there's some serious problems in China. I don't think you can see the decline in world trade that we've seen. Let me just give you a statistic that I think is very informative. Serious global economic downturns are usually contemporaneously correlated with a sharp decline in global trade. Okay? We have seen, many of you may know this, we have seen a very sharp decline in global trade over the last 6 or 7 months. And yet, global growth doesn't look that bad. And I think that's basically telling you one of these two numbers is fudge. Okay? And the one that's truly credible is world trade, because that's, that happens exports, imports. You can measure that several different ways. So I think China is already undergoing a serious economic correction. And in fact, if you look at data on electricity consumption, if you look at data on freight, how much rail freight throughout the country, you see it there as well, that there's already, electricity consumption actually year-over-year growth was 0% in the last year in China. Now so I think that China's in real trouble. I'll be frank about that, and I'm happy to have people disagree with that, but I think China's in real trouble. The bigger picture question is how much will that affect the world economy? Now, being from the U.S., I may have too much of a U.S.-centered focus. I think this region of the world is probably more exposed, but I actually think the actual direct effects of China on the U.S. are quite limited, other than through asset prices, okay? So what we seem to be seeing is that bad news in China seems to lead to a correction in, say, the S&P 500 that's much larger than you can justify given the cash flow exposure. I think that's because we're in this kind of Alice in Wonderland weird world of negative interest rates and central bank policy. Everyone's using signals to then dramatically change their expectation of all asset prices, right? So even news from China that may be kind of small in the world scheme of things ends up being amplified and correcting all asset prices. Likewise, let's see what happens in this Fed meeting today. What time is it? It's not actually, the decision will be out in, what, 3 hours or so? Another 2 hours, so I've got to make sure I know the timing, the time difference. Likewise, a lot of the decisions of the Fed are a focus of a lot of volatility. So I think that's the way in which it potentially could affect the world, is through an asset price channel, not a direct trade channel. And my view is I'm still we do the exact calculation in the book. So if you do so you basically have to do standard option pricing. It's an option on the upside. So let me explain the way the exact contract works. The exact contract works, you buy a home, okay? Financier lends to you. If the home price rises when you sell the home, I get 5% of the capital gain, okay? On the downside, we don't put it on the actual home price of the home, because we think that has bad incentive things for you not taking care of your home. So instead, we put it on an index at what we call the zip code level in the U.S., which is about 3,000 households or so. If zip code level house prices fall, the principal balance automatically adjusts, as do the interest payments. And what we found is that that's essentially a break-free contract, that if you offer, doing the option pricing using historical data, if you offer a 5% of the capital gain, I'm willing to provide this downside protection for the exact same interest rate I used to charge, at least initially. That's how the pricing would work. Now, actually implementing this contract in the U.S. faces the difficulty that banks have capital requirements, and likely the capital requirements for such an instrument would be much higher than for a standard mortgage. So that's a regulatory architecture issue that's a challenge, for no doubt. And it's not surprising to me. I always tell this story. When a hedge fund or a private equity investor calls us and asks us about this contract, they're asking us questions like, how would the option pricing look? When a banker calls us about this contract, they ask, what's the capital charge? Would Freddie Mac and Fannie Mae call it a conforming mortgage, right? So bankers are just necessarily, in some sense, have to work within the network of regulations that they face. And so I think that you would have to kind of dramatically change the regulatory architecture in order to do this type of product. I totally agree with that.
I think, Mr. Azhar, you had a question?
Yeah. Am I on? Hello?
No, you're not on.
I'm on. Okay. You mentioned, Professor Sufi, about this Alice in Wonderland world that we're living in. I think Rajiv mentioned it in his remarks as well, of easy money, low interest rate. We're seeing that not only in the United States, we're seeing that with the ECB action now as well. How does this end? How do we extricate ourselves from this mess?
It's difficult. I mean, the first thing I would say is that one of the universal feelings I get from people who work in the private sector relative to academic economists is more disillusion and anger with the central bank. And I think that's, in some sense, justified. But the only pushback I would give is that we're asking central banks to do everything in the advanced economy. The fiscal authorities, especially in the United States, have been incredibly incompetent, have been just doing a terrible job. The central bank is going to do what it knows best, and what it can do, which is to control the short-term interest rate. That's all they have control over. And they can do some quantitative easing and some other things. They essentially work with a model that is, in my view, just totally incorrect. Okay, and I gave the keynote lecture at the Bank of International Settlements annual conference, which my entire lecture focused on that. And let me just give you the short version. They focus on what I would call a representative agent model. which is just they think of household sector as one unit. And they kind of think, well, if we push interest rates down, households are going to borrow more because the interest rates are lower. That's, of course, ridiculous. Households generally are diverse. They're heterogeneous. And the problem in advanced economies is the households that would normally borrow and spend when interest rates are lowered don't have access to lending. Banks aren't lending to them. So they don't seem to understand that no matter how far they push down interest rates, Bill Gates isn't going to start spending just because interest rates are negative 0.5%. Okay? Bill Gates is just not going to care. And so that's basically the game, the trap they've fallen into. So instead, now they're just focused on trying to devalue their currencies. They're trying to do different things, but they fundamentally are unable to boost demand in the standard channel because exactly the people who normally would spend and borrow at low interest rates are just either out of the market because the banks won't lend to them, or they themselves have become much more conservative and are trying to rebuild their balance sheet so they won't spend in that way. And I think that's, if I would point out one main mistake they're making, it's that they don't seem to understand that no matter, pushing them even lower is only going to lead to more asset price inflation. It's not going to affect the real economy. It's kind of ironic because I'm a finance guy that kind of comes to macro from finance. And the criticism of finance people is we focus too much on asset prices and not enough on the real economy. And in some sense, the central banks have it the opposite way now. It seems like the only thing they can affect are asset prices, but not anything in the real economy. But yet they continue to push as if that's going to help, and it's just not helping.
I think there's a question over there.
My question is about regulation. So if debt is the root cause of all these evils, then the suppliers of debt must be put into question. So what role will regulation have in the future on the suppliers of debt or banks? We know the banks are easier to regulate, but there's so many other suppliers right now. So in this whole scheme of things, if household debt is the root cause of these crises, then will the future see a more interventionist kind of stance by central bank and other regulators on the suppliers of credit?
Yeah.
Have we seen any evidence of this anywhere in the world?
Yeah, so that's a great question. So I think that the main, most efficient and targeted intervention that would help to resolve this problem. And let me just be really clear. I don't mean to say all household debt is evil. It's really these sharp increases in household debt that occur over a short period of time. When that happens, I think it is incumbent upon the central bank to at least consider doing things like loan-to-income restrictions on households. Okay? That has happened in many countries. Bank of Korea has done this. The Bank of Israel has done this. Most prominently, actually, Mark Carney at the Bank of England has done this. So let me just give you that specific example. In July of 2014, the Bank of England imposed a rule on all of its major banks that said that no more than 25% of your mortgages can be at a loan-to-income ratio higher than 4. Okay, so the balance of the mortgage could not be higher than the income greater than a factor of 4. And what was really fascinating about this is at the time they imposed this restriction, it wasn't actually binding on any bank. No bank actually had more than 25% of their originations at that level. But according to Mark Carney, and I have yet to look at the evidence, there actually was a slowing down of house price growth after they implemented this policy. Now, like most of these bubbles, it lasted a while and then they started to accelerate again. There is evidence from the Bank of Korea that they're actually quite effective. They can actually cool housing bubbles when they're really being fueled. They have, it's a different country, right? South Korea is able to implement regulation that would never work in the United States. I mean, they're able to put loan-to-value restrictions at like 60%. I think that would never happen. People in California wouldn't be able to buy a home if you had a 60% LTV restriction. But I think that's the most directed intervention that I think at this point, I am a University of Chicago economist. I generally am I'm hesitant to encourage regulation or intervention in markets. But I think we have so much evidence at this point that I think it is justified potentially to put, during booms, these restrictions on loan-to-income ratios.
Perhaps, change the focus a little bit. You mentioned something very interesting in terms of the risk sharing of the element of the debt itself.
Yeah.
And I'd like to perhaps get your comments on the elephant in the room that hasn't been mentioned as yet, which is credit default swaps.
and the other derivative mechanisms which have created what I will call a false sense of security that you referred to, as to why the debts then can be resold, because we know the banks, when they provide the debt to the households, don't hold it for 25 years. Package it up and resell it. They resell it because they're able to put a derivative wrapper around it. Now, the notional value, we're just in the International Bank of Settlements, which tracks the volume of derivatives, credit default swaps in the world, which my understanding is have gone up from $630 trillion to $730 trillion since 2011, which means that this is an area which is, let's say, supporting the whole volume of debt in many of the markets you illustrated, and has grown without regulation. In fact, this is one area, despite the bank reforms that have occurred in the UK and the US, has been completely left in the back room, so to speak. I welcome your comments.
Yeah, so in the U.S., I mean, one of the big efforts has been to move credit default swaps onto exchanges, for example. This has been a big push by Ken Griffin at Citadel and others. And the argument is that that would help by having a market maker and having more liquidity. That would at least provide some insurance to this market, you know, in case things go really badly. Because the over-the-counter structure of the market really does worry a lot of people. The specific question you're asking, I think it would take me an hour to fully answer. But let me just give you my quick take on the credit default swap market. And that is, I share your concerns, especially when you look at these big innovations in credit default swaps, especially in 2007 in the US. It looks at this point that this is all basically either A, just gambling on house prices, or B, in particular, it's a way to basically, we go through this argument in the book, actually. We have a big section on credit default swaps, where we talk about how there's this one parameter, which is the correlation of defaults within the pool of the underlying securities, which if you can basically convince investors that's very low, you can leverage these things up and, as you said, put credit default swaps on it and really expand leverage in a dramatic way. So if, as an outsider, this is a very cynical view. It oftentimes looks to me that a lot of these markets are so successful because we can reduce the disagreement to this one parameter, which is this correlation coefficient. And if you can convince someone it's low, you can just really lever up massively. If that assumption ends up being incorrect, which it obviously was with house prices in the US, right? Investors were somehow convinced that house prices in California and New York are uncorrelated, or they're almost perfectly correlated, ex post, then you end up getting a big blow up. So that's my brief answer. The longer answer to your question would take an hour, I think. But it's we've discussed some of these issues in the book.
I think there's a question here.
Yes, a fascinating idea about the risk sharing. I think that probably appeals to a lot of the Islamic bankers in the room, this part of the world. But my question is, I mean, have you looked at potentially bifurcating the market into higher risk assets and lower risk assets, or would your model necessarily have to apply equally across all assets or housing assets or other assets, or can you maybe apply this more to the higher risk and the lower risk ones can still have conventional financing?
Yeah, that's a great question. So let's think about it from the perspective of the suppliers of finance. So the people who actually have the money that want to invest. And I totally agree that there is actually demand for what you're calling low-risk assets. I mean, currency is the most obvious. Right? We all have demand for some liquidity. We may also have the demand for treasuries in the U.S., bonds in Germany. My argument, I believe, and this is a controversial view for sure, is that the fundamental demand for actually low-risk assets is actually much smaller than what we're witnessing being produced by the financial sector. And the reason I think we're seeing so much safe asset production is more because of regulation than anything else, right? So if you tell mutual fund, money market funds that they can only hold AAA rated securities, well then you're going to have to produce those AAA rated securities. If you tell insurance companies that they can't hold high yield debt, well then they're not going to hold high yield debt. So my view is that if you actually had the primitive economy, that's the benefit of being an academic economist. We can think of the primitive economy with no frictions. If we just had a simple, if this room were an economy, right? My view is that the actual demand for safe assets would be, be able to be satisfied by the government, essentially. If there's demand for safe assets, let the government provide it, right? Through treasuries, through reserves. And I think that's what happens in the U.S. And in fact, the U.S., most of this stuff has been crowded out because the central bank has expanded reserves so much. So there's not that much demand for safety. So just to link this back to what I was saying to before, I was focused on the perspective of the borrower, right? And what we should give the borrower. And so there's always this counter argument. Well, people want safety. People want the low risk assets. I think we have to think very carefully about what's actually driving that safe asset demand. I actually don't think it's a primitive of people's preferences, that everyone wants safety. I think it's a function of more of the regulation that we've imposed on the financial sector, where they have to hold safe assets, because we tell them through capital charges, through regulation, that you're supposed to hold safe assets. So I think that's what's going on.
Professor, I have a question, which is really based on the cause of the debts, especially with the U.S. economy, the reason why the debt increased to the extent that it did. And is it in some ways dependent on the fiscal policies that were followed by the U.S., where the polarization of incomes between the very wealthy and, of course, the middle class were further pushed down, resulted in aggregation of wealth at the top end, and, as you said earlier, deprivation at the bottom end. And therefore, when you need to move aggregate demand, it's very difficult because the people who have the funds are not the people who are spending them. So to what extent would the fiscal policy need to change of the United States to really sort of alleviate the situation?
Thank you. These questions give me a lot of happiness because that question is exactly the focus of the afterword of the paperback. It's exactly that. So let me just give you the short version. And that's essentially, as you framed it, is basically exactly my opinion, which is that it's no surprise to me that the 1920s and the 2000s are the two periods under which wealth inequality increased the most, and it's also the same period in which you saw the expansion of debt more dramatically than any other period. I think these two things are fundamentally linked. And at the end of the day, you can view it from several angles. I actually think conceptually, a lot of people focus on the low-income people and they say, oh, they need to borrow. But actually think about it from the perspective of the high-income people. Okay? If you have a group of people who have a lot of wealth, they're obviously not going to consume most of their wealth. It's just impossible for rich people to consume. I mean, how many yachts can you buy, right? So they put money into the financial system. The financial system is going to first try to find productive investment, right? Businesses that want to invest. At some point, that's just going to run out. Then what are they going to do with that money? Bankers aren't paid to just invest in treasuries. So they're going to have to look for investment opportunities. Where are they going to come from? They're going to come from expanding into the lower segment of the market. And that's what you're seeing over and over again. So you can think about it from a demand perspective that the low-income people want loans, but you can also think it from the supply of financing. And I totally agree with you that the only way we're going to, in the long run, have a solution to this is more aggressive, like infrastructure investment, especially in the United States. So I'm very much in favor of the kind of Larry Summers view of the world that we need in the advanced economies. Martin Wolf has also given this, that we need a lot more infrastructure investment. But that's the only way in which the savings of the rich, through implicit taxes in the future, get channeled into investment demand that's efficient. Unlike, people borrowing against their homes to buy boats. That's not an efficient form of consumption. That's going to run out. And instead, we might as well, I don't know how many people, obviously most of you have been to the U.S. Our airports are just an embarrassment. Just an absolute embarrassment, especially when I travel this part of the world. It's kind of depressing to think of what LaGuardia and people go into JFK and O'Hare, this is their first experience in our country. It just seems like there's so many ample opportunities to do investment in the U.S. that are just being passed up. That's a great question. So our recent research does the horse race, essentially, between these three components. Non-financial firm debt, government debt, and household debt. And in advanced economies in particular, so think US and Europe, household debt wins by far. So increases in firm debt in those countries, the sample period is 1960 to about 2010. In that sample period in advanced economies, firm debt, once you control for the household debt factor, has almost no predictive power. Likewise, government debt has very little predictive power. It's really about households. Emerging economies are a little bit more complicated. It seems to be a mix of both. So for example, the East Asian financial crisis is a great example. In the late 1990s, or basically in the mid-1990s, A lot of those countries, think about Korea, think about Thailand. Thailand is a great example. Thailand had both a massive increase in both firm debt, but also household debt in the 90s. In fact, in 1998, the price per square foot of housing in Bangkok was as high as it was in San Francisco. Okay? So there is, many people think about the emerging markets crisis as always being about non-financial firm debt, and it is oftentimes focused in that area, but at the same time, often households are also borrowing very aggressively. This is also true of Japan in the late 1980s. We all know about the commercial real estate boom, of how house prices in Tokyo fell 80%. There was also a lot of household borrowing in Japan in the late 1980s. And so that ends up having good predictive power over how severe the recession was. So the bottom line quickly is just advanced economies, mostly household. In emerging economies, it's kind of an equal share. But even in emerging economies, government debt is not that important. Firm debt and household debt are.
And
Well, there's a lot there, so let me try to focus on a few aspects of it. Let me link, first of all, the question back to the same question that was asked before, and that is, if I presented this argument for a standard University of Chicago neoclassical macroeconomist, and I said, oh, wealth inequality, there's no money to go to better investment opportunities, it goes to the poor instead. They say, what are you, crazy? There's a whole world of investment opportunities. There's China, there's East Asia, there's Southeast Asia. There's, of course, great investment opportunities. And so let me put it a little bit back on the people in this room, and that is, the simple macroeconomic model would tell you that if the rich and the advanced economies want to save a lot of money, that should find its way into where the marginal productivity of capital is highest, and that should be in emerging economies. This has been one of the biggest mysteries of macroeconomics over the last 15, 20 years, and that is, why in the world is China a net saver? Why is Thailand a net saver? These are economies that should have very high productivity of capital. Money should be flowing into these countries, thus boosting demand, maybe not through consumption, but through investment. Now, China's obviously boosted investment in a big degree, but your points about consumption are related to that. that why doesn't more money flow into these countries? Some of it's management by the central banks. The general argument that's been given, and that's why I think it really comes back to the people in this room who work in this region, is that the financial development is just lacking and needs to be improved so that we can take advantage of the good investment opportunities. That sounds very much what dunia is trying to do, what other banks are trying to do. And I do think that that is an important part of the solution to this problem, and that is to try to get capital into emerging economies for efficient investment, not just boosting consumption in the short run, but to actually improve business productivity, to get better workers on the floors of factories. I think that is a very important goal that the financial intermediation sector should be doing, and I think they are doing to some degree, but I think it would be better to see more of that. And I think that could potentially help to solve this global demand shortfall by boosting investment in productive ways, and also boosting consumption, I think, to some degree. Let me make a second point quickly, and that is just about central bank policy. I have been in several meetings with emerging market central bankers at the same table as advanced economy central bankers, and you can probably guess the names of the people involved, in which the emerging market central banker is saying, you guys just completely ignore us when you make your decisions, you don't have any coordination whatsoever, and the advanced economy central banker is saying, that's our mandate, that's what our government tells us. Our government doesn't tell us to worry about China or India when we set our monetary policy. So that's going to be a conflict that's going to continue to be there. And you can see it. I mean, people are so angry at Japan right now for this recent decision. You know, Hiroko Kuroda, he doesn't care. I mean, he's not paid to care. That's not his mandate. He's not going to care about what his effects are on emerging economies. He's going to care about what happens in Japan. So I guess I have a note of pessimism there that I just don't think you're going to get past that. And on the fiscal side, who knows? I mean, we can't even do fiscal policy in the U.S. in a sensible way. So who knows how we could coordinate it with other countries?
I think we have some questions on this side.
Yeah. Hello?
Maybe go ahead, Mr. Abdullah, and then we'll come back.
Professor, if the debt contract would require lenders to take on a different type of risk, more risk, my question is, why would lenders want to do that if they have the safety cushion of bailout, and I assume greed still trumps morally sound business practices?
Yeah, I mean, I think what you're hinting at is that the current regulatory architecture, if you think about it in terms of bailout subsidies, or discourages exactly risk taking. And I completely agree, and that's my experience. But I will tell you that in the U.S., there is a significant part of the financial community that is not within the traditional banking sector, hedge funds and private equity investors, who are very interested in this product because, again, they're willing to take an upside. They want an upside on real estate prices. As long as you continue to have the government support of the traditional banking sector, I agree. It's going to be hard for this program to take off. That's one of the advantages of sitting in the ivory tower, right? You have the idea, you hope it gets implemented. And to be frank, one of the people who worked on our book as a research assistant actually has been introducing this product in Chicago. He's doing it through community banks, which I think are more willing to experiment a little bit. And he's had some success, going to low-income neighborhoods and explaining to people, look, if you take this kind of mortgage and your house price falls, then you won't be bearing so much risk. And he's had some success in that. So, little steps, I guess, little steps.
I had a question on Japan. It seems to be largely forgotten these days. They've tried everything there. They've tried quantitative easing, Abenomics, on-priming. The Bank of Japan is in negative interest rate territory now. And the patient seems to still be in a coma. Yeah. Is there any hope for Japan, do you think, or is it going to stay this way?
Economists usually are split into two groups on Japan. One, believe in kind of a more Keynesian story that this is all, deflationary pressures. The other is that these are more long-term structural issues, the aging population. And I think the structuralists are starting to win the debate. I mean, as you said, they've tried everything that the textbook Keynesian, approach would be. Massive monetary stimulus, fiscal stimulus at different times, and nothing seems to work. So in my opinion, it does seem like a longer-term structural issue with the aging population. It's very unlikely they're going to start allowing immigrants in or anything, so I don't really see any way out of this. And I think we should be a little cautious. It's not like things are a disaster in Japan. It's not like people are starving in Japan, right? I mean, it's just that they're not able to get the kind of growth we think advanced economies should get. And I think we're just at a new normal where that is the way it's going to play out there, unless somehow they have a big population surge, which doesn't look likely. obviously not through fertility, and then it doesn't look like they'll ever have a lot of immigration there, just given cultural norms. I tired you all out. That's my goal. So hard to do better.
Great. So thank you very much, Professor. It was a pleasure having you. And thank you, everybody, for being with us tonight. Please join us for some more drinks and canapes outside. And to get your personally signed copy, it's also outside on your way out. Thank you.
Thank you.
We're Dunia. We do things differently.